This is Bloomberg Businessweek Daily, reporting from the magazine that helps global leaders stay ahead, with insight on the people, companies, and trends shaping today's complex economy, plus global business, finance, and tech news as it happens. Bloomberg Businessweek Daily with Carol Massar and Tim Stenovec, live on Bloomberg Radio, television, YouTube, and Bloomberg Originals.
And a very good afternoon, everybody, across Bloomberg platforms. Carol Massar, Tim Stenovec, live here at Bloomberg headquarters in New York City. Kind of have a theme today. It's all about keeping score, whether it has to do with the U.S. economy and the jobs market, what's going on in terms of the composition of the U.S. Federal Reserve. And then we've got our own keeping score here, courtesy of Power Players New York.
Yeah, more on all that in just a moment. On the program this hour, we got Max Levchin, the co-founder and CEO at the buy now, pay later firm Affirm, joining us in a few minutes. Also, we're going to hear from John Malone. You know him, chairman of Liberty Media, an absolute legend when it comes to the media industry.
It's a C-suite palooza. I'm going to just put it out there. Scott Cutler, president and CEO of HealthEquity. So we're going to talk about that, the health space, certainly working with a lot of employers. And then we are going to tee up the Bloomberg Power Players New York that's underway. It's going on a couple floors above us. It's all about the multi-billion-dollar world of sports, the business people who are in it, the players, the team owners. We're going to have a few over the next 3 hours. So we're going to tee that up for you as well. First up, though, we do want to get a check on the trade today. We've got a bit of a rally underway. Here's Lisa Mateo in for Charlie Pellet.
You got it. And yeah, the latest readings on hiring, unemployment claims, it pointed to a cooling labor market, and that is driving stocks and bonds higher. So applications for U.S. unemployment benefits, they rose to the highest since June. Private sector payrolls, they increased by 54,000, trailing estimates. It all comes ahead of tomorrow's jobs report. So we check in with the NASDAQ. It's up about 0.5%, 118 points. The S&P 500 up 0.5%, and we have the Dow up 0.7%. In the yield space, we have the 2-year 3.59%, and that's down about 4 basis points. The yield on the 10-year 4.18%, and that's down about 3 basis points. The Bloomberg Dollar Spot Index is up about 0.2%. Few stocks on the move. On the downside, we have software company Salesforce. Shares are still taking a hit. They're down about 5%. Its quarterly revenue outlook, it was on the lighter end of expectations. And then you have newly listed software company Figma. Their shares are down 18%, posted a double-digit rise in quarterly revenue, but here's the thing, profit missed expectations. On the upside, American Eagle Outfitters, their shares up 32%. They said it expects sales boost from marketing campaigns featuring, yes, Sydney Sweeney, but also Travis Kelce. And since we mentioned retailer Gap, it says it plans to test a broader range of beauty products and accessories. Yes, starting at its Old Navy stores this fall. Gap shares, they're up about 4%. For on-demand news 24 hours a day, subscribe to Bloomberg News Now, wherever you get your podcasts. I'm Lisa Mateo. That is a Bloomberg Business Flash.
It's all about those beauty products, man, Lisa.
Yes.
It's all about
you need
margins.
them.
Wait, are you saying I need them? Wait, what about Tim?
I am wearing a healthy dose of makeup right now. Is that what you say, a dose? I don't even know. Application? I don't know. Help me out, Carol, please.
We need to move on. We need to move on. All right, Lisa, thanks so much. Hey, listen, we got a big drop of economic news on the U.S. economy today. Applications for U.S. unemployment benefits rising to the highest since June, adding to evidence that the labor market here in the U.S. is cooling, yet hiring plans falling to the weakest level for any August on record in data from outplacement firm Challenger Gray and Christmas, going all the way back to 2009, while intended job cuts rose. And then, Tim, we also got to read on the service side of the U.S. sectors. U.S. service providers provided expansion in August at the fastest pace in 6 months, on the sharpest acceleration in orders in nearly a year. That wasn't the only thing going on.
No, it wasn't. President Trump's pick for Fed Governor Stephen Miran up on Capitol Hill today, taking questions from members of Congress, including when it comes to Fed independence.
I couldn't be more in agreement that independence of the central bank is of paramount importance for the economy, for financial markets, for the long-run stewardship of the country. All of those are completely, I'm in complete accord with. Look, the president nominated me because I have policy views that I suppose that he liked. If I'm confirmed to this role, I will act independently, as the Federal Reserve always does, based on my own personal analysis of economic data, my own personal analysis of the effects of economic policies upon the economy, and act based on my judgment of the best economic policy possible.
All right, that was President Trump's pick for Fed Governor Stephen Miran up on Capitol Hill today. Bloomberg's Michael McKee is also in the nation's capital there for the hearing. He's Bloomberg TV and Radio international economics and policy correspondent, joining us from that said news bureau by Bloomberg News in D.C. Hey, Mike, I got to ask you, at a moment where it feels like there's a lot that feels so important for the economist in you, for the monetary policy person in you. We got readings on the labor market, on the U.S. economy, the hearing of Stephen Miran. We've got pressure on Lisa Cook continuing over at the Fed. What's really so important right now when it comes to the kind of economy and the monetary policy outlook?
Well, it depends on whether you're talking short-term or long-term. Short-term, the question is, what is the Fed going to do on September 17th? And today's ADP number, which you didn't mention yet, 54,000, lower than anticipated, is a suggestion that the Fed is going to be on track to cut rates because they've been concerned that low employment and any rising unemployment would be a sign the economy is slowing down that they'd want to get ahead of by cutting rates. ADP hasn't always been completely reliable, but the Fed, several Fed officials have said they're looking at that more closely these days because of the questions about the revisions to the prior NFP reports. So on a short-term basis, I would say that, and the fact that in the ISM services number, the employment numbers were still very weak. Longer term, it's the Lisa Cook situation that worries people, because if the judge, in her effort to try to stay on the Fed, says she can be fired, or if an appeals court says she can be fired, and Trump immediately moves to replace her, even though her case has not been adjudicated yet, then there's going to be some concern on Wall Street about politicization of the Fed. So we got the latest filing from the government in the Cook case today. The judge could decide tonight, could decide tomorrow, and that'll be the next important step for the longer run.
Is she working right now at the Federal Reserve, Mike? Do we know that? I know there was some confusion about this last week and even early this week.
It's our understanding that until the judge rules otherwise, she is still employed by the Fed, and she is still working, although working from home, we understand. But she hasn't had her job or her electronics taken away, so she can still participate. And if the judge lets her, she would be attending the September 17th meeting and voting it.
If she doesn't attend it, can she still vote for policy that day?
No, you have to be there to vote. And the thing about the Fed governors is there's no alternate. If a voting regional Fed president can't make it, then there's an alternate voter for them. But that would just be one fewer vote. And the question is Stephen Miran going to be confirmed? Because that would be one fewer vote as well if he's not confirmed in time.
All right, so let's go there. I mean, do you think Miran's going to be confirmed? And what will that mean in terms of the composition of the Fed?
He'll be confirmed. The president has said he wants him confirmed, and Senate Republicans generally do what the president wants. The only question is sort of technical. Can they get him through on the through the floor, given the calendar that they have? They have a lot of nominations backed up, and they'd have to move some things around. But it probably is going to happen. Now, the question is, what kind of reception would he receive, and what impact would he have? He was not well received at all by Democrats today, who pointed out the contradictions in his testimony, that he said he's going to stay on the CEA, even though he's said nobody should go back to their government job for 4 years after leaving the Fed, and after he criticized Lael Brainerd and Austin Goolsbee for going from a Democratic administration to the Fed and called that sinister. On the Democratic side, he hasn't got any friends. And then in his report on reforms that should be made to the Fed, he not only criticized Brainerd, but he criticized Mary Daly and Austin Goolsbee. And so will they be very friendly when he shows up?
Can't wait for Thanksgiving dinner when they all get together around the table. Should be warm and cozy.
It's just like I don't even know where to go from there. I do want to talk a little bit more about this hearing, though, Mike, and the idea of independence of the Federal Reserve was certainly dominant in the hearing today. And I'm wondering what the contradiction is, or maybe you can explain the contradiction in saying that like being independent on a body while retaining a job at the White House. How is that actually possible?
I think that's a question that answers itself, Tim. There's no real way to separate the two things, and I don't think anybody even if he didn't say he was going to keep the job, was going to think that he would be an independent voice. As he noted, the president picked him because he has views that he likes, and while he will bring his own views and be independent in making his decisions, his views align with the president's. So he's going to be a reliable vote for a rate cut, it's really just that the idea that he would stay on, even in an unpaid role as an employee of Donald Trump while he's on the Fed, it's just kind of a blatant hypocrisy. But that's kind of the way Washington's been working lately.
Mike, what did you make around the question and answer portion that focused on the former Federal Reserve Chair Arthur Burns and the idea of Fed independence and stagflation and presidential involvement during Arthur Burns' tenure, and the way that Miran handled that line of questioning?
Well, they were obviously trying to trap him into admitting that because the Fed was influenced by Richard Nixon in 1972 and they kept rates too low for too long, that would happen again. And of course, after 72, we got the great inflation of the 1970s. Miran tried to tap dance around it. I wonder how much relevance it has anymore because a lot of the people who were on that Senate committee probably weren't born then and so don't remember it. So at this point, it's ancient history. It is a cautionary history that Fed officials are very aware of, but I'm not sure it scores a lot of political points.
All right, we're going to leave it on that note. Hey, Michael McKee, thank you so much. I really appreciate it as we get ready for that monthly jobs report out at 8:30 a.m. Wall Street time tomorrow. Mike, of course, will be all over it with the team. He is international economics and policy correspondent at Bloomberg TV and Radio. I should point out that Fed Bank of New York President John Williams has said his forecast is that it will become appropriate to cut interest rates over time without clarifying the timing or pace of such moves. We know as head of the New York Fed, that voice is certainly an important one. All right, now let's get to a Bloomberg exclusive. Bloomberg
News correspondent and host of the Big Take podcast, David Gura, caught up in an exclusive interview with John Malone, chairman of Liberty Global, earlier today to talk about his new book, Born to be Wired. It was released on Tuesday, September 2nd. Here to tell us more about that conversation, we've got Bloomberg News entertainment team leader Chris Palmeri joining us from LA. Chris, John Malone, an icon for anyone who has followed the cable industry, the development of it, the growth of it, and of course also the decline of it in recent years. Known for his outsized role and creative deal structures. Just give a quick overview for people who might not be familiar with the impact that he's had.
Well, so joined this tiny, struggling Denver cable TV company, Telecommunications Inc. in 1972, 3, I think. And, this is even, before all the cable channels that we know as household names now existed, built it into the largest player in the business, helped launch CNN, Fox News, BET, you name it, sold it to $48 billion to AT&T. In a way, kind of bought it back again later. Now still controls Charter, the largest cable company in the U.S., Liberty Global, the largest in Europe, architected the merger of Warner Brothers and Discovery that they're now splitting up. So just a huge player in the business for 50 years now.
All right, and he does have a new book out, as we mentioned. It is called
Born to be Wired.
Born to be Wired, which is like a perfect title for him. Let's get to some of the conversation that John Malone had with Bloomberg's David Gura about his journey in the world of media.
I had a great mentor early, Moses Shapiro at General Industry. He was the chairman. And he was a tough old bird, but he would teach me about the Talmud. Okay? And he said, one of the things the Talmud teaches you is ask yourself the question, if not.
If not.
If not. So if your model, if your business plan works, great. But ask yourself the question, well, what if it doesn't? What if your assumptions are wrong? What if this doesn't work or that doesn't work? Where are you at that point? What's the downside? How much risk are you really taking? So you really try and look risk very hard in terms of how you finance something. Do you have partners in it? The government's always your partner from a tax perspective, so don't forget that you can deduct your failures from your successes. Don't ever get to where you can't. You're going to have lenders. If they have risk, they're going to help you make sure that you're not taking too much risk. So they become good partners in assessing risk. And if you structure it properly, if you do get in trouble, they're buying lunch, you're not, right? Kind of an attitude. Don't ever count on anything being for sure. And so that has colored the structure of the organizations that I've put together over time. So a typical thing for me would be no debt at the parent. Subsidiaries would be levered rationally but substantially, particularly if there's tax or other advantages. And so the parent was always in a position to rescue the subsidiary, but never in jeopardy of a single torpedo, a single bad thing taking it all down. So risk avoidance coming out of the TCI survival, I think, was the #1 lesson that I learned. Diversify, never cross-guarantee, never consolidate liabilities unless you're really, really comfortable. Just to get an eighth of a point better deal on your financing, don't go there. Try and isolate your risk. We even came up with a strategy called the outhouse theory. If you're going to do what you regard as an uncertain acquisition, buy it into a standalone capital structure. Be willing to pay whatever the debt risk represents. Make sure you can refinance it timely if it works. And if it doesn't work, structure it so it doesn't poison the whole barrel of apples.
All right, that, of course, is John Malone of Liberty Global. He is there with Bloomberg's David Gura, and it is the subject of a new Big Take, Bloomberg Big Take podcast. Keep in mind, Malone's book just out this week, Born to be Wired. I feel like, we're talking with Chris Palmeri, who follows the media and entertainment space. He's entertainment team leaders out there on the West Coast, where there is so much going on in terms of content, but the world has changed so much. Chris, since John came into it, what about this conversation, kind of caught your attention?
The conversation and the book, it's very interesting. So Malone is very hands-on when he's describing, for example, then how he built up the company using all these partnerships and sort of the divisions that were collateralized with the parent company, and that fascinating stuff from a business standpoint. But, when he gets into kind of the macro picture about how the cable TV industry raised prices so much and didn't let customers choose which channels they wanted to watch, and how he engineered the Warner Brothers Discovery merger that is, by all accounts, a disappointment, and they're now splitting it up. All these things he kind of takes in as sort of as an observer, as like he wasn't really in the thick of it then, and orchestrating these deals and running the largest cable operator in the country and continuing to do so. So it's a fascinating view of the world. At least he agrees that the cable industry kind of cooked its own goose and just didn't adapt to the times and give people the streaming options that they now choose from others.
Yeah, it feels like there was a moment in time, right, that nothing could be done in the media space without kind of a blessing from John Malone. There wasn't any media conversation without us, Tim, touching on John Malone.
Yeah, I think that's certainly fair to say. And for many years, it was the idea that live sports would keep the cable bundle intact. And look what ESPN did last month. You can now buy ESPN direct to consumer. You can bypass your cable system to do that. That is a very big deal.
Like who'da thunk, right?
Yeah.
In terms of how times have changed. Chris, thank you so much for walking us through all of that. He is Bloomberg News entertainment leader, Chris Palmeri, out there on the West Coast. Check out David Gura's entire interview with John Malone. It'll air on the Big Take podcast. Coming up next, a double dose of the C-suite. We've got Max Levchin, co-founder and CEO at Affirm, and Scott Cutler, president and CEO of HealthEquity. That's all coming your way on Bloomberg Businessweek Daily.
It is 2:21 on Wall Street. I'm Lisa Mateo. Stocks are advancing. This is as President Trump pushes for greater influence over the Federal Reserve with the Senate hearing wrapped up to confirm Stephen Miran. Now, Wall Street strategists, they're starting to weigh in. You have JP Morgan and Goldman. They're warning of growing concerns over the Fed's independence with the president's push for Miran and rate cuts. And then meantime, the Justice Department, well, it opened a criminal investigation into whether Fed Governor Lisa Cook committed mortgage fraud. We have the NASDAQ. That's up about 0.5%. The S&P 500 up about 0.5% as well, and the Dow rising 0.7%. Heading over to the yield space, we'll start with the 2-year, 3.59%. That's down 2 basis points. The yield on the 10-year, 4.18%, and that's down about 4 basis points. The Bloomberg Dollar Spot Index, that's up about 0.1%. Some of the biggest names in tech, well, they're attending an AI event. It's hosted by First Lady Melania Trump in Washington. That's going to be followed by a reception over at the Rose Garden with the president, the leaders of Meta, Apple, Alphabet, OpenAI, Microsoft. Those are some of the big names there, as well as Microsoft co-founder Bill Gates. And DeepSeek, they're stepping up the competition against rivals like OpenAI. Sources say it's building an AI model with advanced agent features with a release planned before the end of the year. And Techtember continues. I got that from Tim. Yes, Samsung Electronics unveiled their $650 version of its premium S25 smartphone and a pair of new tablets. For on-demand news 24 hours a day, subscribe to Bloomberg News now, wherever you get your podcasts. I'm Lisa Mateo. That is your Bloomberg Business Flash.
We're making it stick, Carol. Techtember.
See?
Mark Gurman said it's okay.
I said when Mark Gurman says, yep, it's a thing, we can kind of run with it in a big way.
Thank you, Lisa. Appreciate that.
All right. Well, people running with Techtember, they're also running with buy now, pay later. It seems to be everywhere nowadays. Companies, including Affirm, Afterpay, Klarna, have all brought installment payments into everyday life, while big banks and tech firms are also now racing into the space. It's getting a little crowded. So with the market growing so rapidly, there are obvious concerns over whether BNPL is adding a new layer of hidden leverage to the economy, giving online shoppers an alternative to more traditional financing, such as credit cards and bank loans. Data about BNPL usage, it's kind of limited. And those firms have so far resisted sharing a lot of information, but we wanted to know more. And this person, our next guest, knows a lot about the space. Here to talk about all of this, great to have with us the founder and chief executive officer of the $29 billion market cap company, Affirm, Max Levchin, joining us today, I believe from San Francisco. How are you?
I'm great. Enjoying this nice warm Techtember.
It's a thing. It's a thing. Talk to us about, first of all, just big and broad, especially on a day when we're getting a lot of economic data. We're waiting for the monthly jobs report, trying to figure out what's next in terms of the U.S. economy. You see a lot when it comes to what consumers are up to. How would you describe the consumer today?
The Affirm consumer, that is the folks that we approve for transactions, and each transaction is separately underwritten. So we do have a very discerning eye as we underwrite these loans. They're doing great. They are shopping. Demand for our product is accelerating. We just posted another accelerating fourth in a row quarter of gross merchandise sales. They're doing really well. Repayment is really strong. Credit is steady to improving. And so we lend to a huge percentage of U.S. population. So you could infer from that U.S. consumer writ large is doing well as well. So I think the rumors of the American demise are greatly exaggerated. That said, we continue to watch every metric we can all the time, because that's what our job is.
Are those metrics stronger now, Max, than they were, say, a year ago?
Again, from Affirm's point of view, we really are firing on all pistons. Our ability to serve folks has improved about 20% year over year. That's measured in transaction frequency. Our user base grew about just north of 20% as well. So consumers are joining us. Our user active acquisition has accelerated for the 6th quarter in a row. So there is a meaningful secular shift from credit cards to Affirm. So I think, again, within our ecosystem, every metric looks very good and better than last year.
Can you talk a little bit about what transactions Affirm customers are using the payment system for? Are they using it like they would use a credit card right now? What's the typical transaction? What's the transaction size?
That's a great question. And it's a little bit differentiated between players, so I can only speak to us. The average ticket for us is just under $300, and that should tell you a lot. So everything from a truly considered purchase, like a nice bicycle, maybe a couple $100, all the way down to a large party supply, maybe a couple $100. Those are sort of the bookends. We tend to believe that really, really low ticket items, $20 is just too small of an amount to finance with Affirm. So we have a notion of, where we start trying to tell our consumers, hey, this seems like a good idea to be a cash transaction. But generally speaking, because the product we offer is just so much better than credit cards for the end borrower, we're very pro idea that Affirm should be used in place of credit cards, full stop. If you think of it very quickly, it is an obvious idea. So we don't charge late fees, we don't compound interest, we don't do deferral or any of the sort of gimmicky things that look too good to be true because they are too good to be true. So it is an honest financial product that really helps the end borrower get full grip on their finances and not get into trouble, not get over their skis. So directionally, the more they use Affirm for everything, I think the better off the consumer is going to be. That said, the current average is $297, I think.
How often does somebody though miss a payment or they're late? And then what happens as a result? What kicks in? I'll be honest, I'm not a huge user.
Well, I mean, have you ever used it?
I think I've used one of them, and I can't remember once because I was curious about it, and I set it up so things just got paid, and it was like 3 payments or something because I was curious about it because we talk about it all the time here. Grew up where you could put stuff away, stuff on layaway. So it's interesting to see the evolution. But I am curious, Max, how often is it that somebody is late and then the terms start to change? And, this is a business, right?
So that's actually... Thank you for that prompt. That is, let me try to make one thing. If there's one thing I can make clear in this conversation, I just really want to hammer this one home. Nothing will change. Terms will not change. Fees will not appear. Interest will not change. No dollar amounts will change if something happens and you can't make your bill on time. The fundamental promise of Affirm is what you see is what you get. When you're borrowing $500 and you're committing to paying, let's say, another $25 of interest, if you cannot make it on time, it will still be $525. There will not be a penny more. If you prepay and pay us early, that interest amount will come down. So it is a profoundly pro-consumer product. That said, I just wanted to make that very, very clear. Yeah. We are a better financial product. About 98% of our consumers are never late, never in default. And so it's fundamentally extremely, extremely high probability of none of that will ever happen to you if you're within the Affirm ecosystem. When folks are delinquent, which is a fancy term for late with their payment, we'll reach out to them. We use all sorts of digital channels to get in touch with them. We'll remind them. Vast majority of folks that are late are actually what's called sloppy payers in the industry, where they say, oh my God, I forgot to set the auto pay. Thank you for using that feature if you did. And they cure it, and so it goes. And so that the reason we don't charge late fees is because for folks where they really cannot, something happened and they lost their job or something happened, they're not going to pay you any faster if they have no means of paying you back. The ones that are just stumbled somehow and forgot, the reminder is the most you need to do. You don't want to penalize them for being forgetful.
So what is the default rate?
It's on the order of 2% plus or minus.
That's remarkable.
Well, I think
it's meaningfully lower. Yeah. It's meaningfully lower than credit cards. By the way, our lower ticket items, that trends below 1%. So just to give you a sense, like the rumors of this being a bad financial product creating hidden leverage in the system is like bad math and ridiculousness.
So push back on that a little bit, but do it through the explanation of the business model here, because I think a lot of people approach this product with being informed about how credit cards work and the idea that high interest if you miss a payment, fees if you miss a payment. In a sense, the risk is somehow put on a different party here, Max. And there's also buy-in from the retailer who partners with Affirm. Just explain how this whole transaction works.
Yeah, very simple. You typically find Affirm at a point of sale on any online and now progressively more offline merchants. You will ask to use the product. So it's always an explicit request to borrow. And we take great pride and put a lot of technical emphasis on underwriting every transaction individually so that we have the discretion to say, hey, you're overextending yourself. These 2%, 2.5% default rates don't come for nothing. We do an enormous amount of work in this underwriting engines that we've built. So as you get approved through your real-time application, of course, What happens, we pay the merchant and you commit to paying us back over time. And we always give you a menu of choices, could be anything as short as 4 payments every 2 weeks, could be as long as 36 months, once every month. The rest of it happens more or less automatically if you opt into the auto pay feature. If you don't, we will send you a reminder and then you arrange for repayment from your bank account typically. And that is it. In our case, there is no compounding. The interest is the interest expressed in dollars, and that is what you commit to. It will not go up independent of any modifications to the schedule. There are no late fees. In our case, again, we are unique, or almost unique, I think, at this point in the industry by just not charging any incremental fees at all, and so on. And so this really is the product where the cornerstone value is transparency. We are entirely transparent with every participant in the ecosystem, from merchants to consumers. Everyone knows what they're getting into. You get your bicycle or your couch or your putty supply today, and you pay for it over time, and you know exactly when the payment plan stops, and then you're no longer in debt. It is a better alternative to credit cards because when you use credit cards, which are very convenient, you don't have this extra approval step, so just drop the plastic and on you go. You're adding to this giant bucket of debt that just sits there and revolves. The interest compounds into principal every month, every week. Whatever it is you've accrued in interest becomes a part of the base that accrues interest on interest on interest. That is why credit cards are so expensive. The reason APR matters as a measure is because it doesn't just measure interest you'll pay on a principal, it's the interest you'll pay on the interest, and so on. The model we invented, the reason we are so important, the reason people are coming to us, frankly, is they don't have to understand exponential mathematics to figure out what is the true endpoint of interest will be. Whatever it is we promised them, that's exactly what they pay.
We're speaking with Max Levchin. He's the founder and CEO of Affirm, the $29 billion market cap fintech company. Also, you'll notice Carol, he keeps talking about bikes. He's a big cyclist, too, so spends a lot of time on the bike.
So is Tim, by the way, Max. Hey,
oh, we know. We follow each other.
I know you guys do. hey, listen, one of the things I want to ask you, your stock is on a tear. It's up 50% year to date. It's surged as much as 25% intraday in response to your earnings, which you've been talking about. That came out late August. You had analysts, several of them raising the price targets on the stock. What's the path to sustainable profitability? What do you need to see happen to kind of keep the momentum going?
We just need to keep doing exactly what we've been doing. The joke I make all the time is we are an overnight success 15 years in the making. Profitability is not an accident. We gave this date exactly a year ago where we said, look, 12 months from now, we'll be GAAP profitable. 2 years ago, we said, hey, 24 months from now, we expect to be GAAP profitable. And so we've been on a journey that we've planned years ago to deliver on all these milestones. And so the celebration isn't of some clever overnight idea that we've had and finally just poked our head from the unprofitable side of the fence. We've been planning to be profitable. We've delivered on this plan. We have said publicly we intend to be GAAP profitable from this point on. That is not a thing you can decide last week and deliver tomorrow. It's something that you build over a long period of time. It takes discipline, takes execution, takes a great team, which I'm lucky to have. And so I'm not worried about that whatsoever. Whatever we commit to, we tend to deliver on.
Well, speaking of time, it's been a long time coming for Klarna and its IPO, and it does plan that here in the United States. Competition in the space is definitely, Max, picking up. They are specifically rapidly expanding here in the U.S. You've got Sezzle. That stock is up about 7,000% in less than 2 years. There's a lot going on. So how are you seeing the competitive landscape evolve, and what does that mean for you guys specifically at Affirm?
We're very happy doing our thing. As I just extolled for a little while, we are different. We do our thing a little bit differently than the rest of the industry. We have a very strong point of view on what is and isn't moral, what is and isn't right for the consumer, for the merchant partners that we have. And it's paid great dividends for us and our shareholders. So in that sense, we intend to change absolutely nothing. Part of why maybe I spend less time looking at the competition than one does in a competitive industry, and this one is certainly very competitive, is in aggregate, buy now, pay later is still just under 1% of total US retail, and it's a worldwide phenomenon. And US is actually quite behind. If you look at markets like Australia and the Nordics, where buy now, pay later is more mature, there the penetration into e-commerce is on the order of 20, 25%, I think. In the US, it's a much more polite 7% maybe. And if you expand it into offline, which there's no reason why this doesn't work offline. In fact, we have a card that's been growing extremely well, better than 100% year over year, just in the last quarter's report. We're a fraction of a fraction. So the opportunity to provide more honest financial products is, I said it in my shareholder letter, sort of tongue in cheek, it rounds up to infinity. And so for now, we're not really running into each other in the hallways, fighting for that last same customer or merchant. I'm sure one day we'll get to a point where it's so significant as a part of the U.S. economy where it becomes, a zero-sum game. But even in that world, there's a Visa to a MasterCard. And for now, I think we're all just experiencing really good growth. And frankly, the fact that the market now will support a couple of large publicly traded companies, probably a good thing. That just gives shareholders a sense for this has a long way to go in terms of growth. Hey,
Max, before we let you go, just 30 seconds on crypto and stablecoins. An opinion piece this week coming from Paul Davies of Bloomberg Opinion. He wrote that stablecoins are an opportunity for merchants and airlines to recover costs from big banks and networks like Visa and MasterCard. Is there a use for digital assets at Affirm?
I think there are interesting opportunities around merchant settlement, which is sort of, I'm echoing what this piece is saying. I'm not yet seeing consumers spending stable coins they have acquired in droves. And so as a back-end mechanism, stable coins are very interesting, and we're certainly looking at the opportunities there. On the consumer side, I think folks are thinking in dollars and probably will continue to do so.
All right, got to leave it there. Hey, Max, thanks for carving out some time for us. Max Levchin, founder and chief executive officer of Affirm. Max, of course, just a great voice when it comes to what's going on in the fintech space. We're going to
also have PayPal fame.
PayPal fame as well.
Part of the mafia,
yes,
as they say.
We're going to have more from the C-suite in just a moment. We're going to catch up with the CEO of HealthEquity. That's coming your way in just a moment.
First up, though, a check of the day's trade and top business stories. Here she is, Lisa Mateo, in for Charlie Pellet. Hey, Lisa.
You got it. And stocks are on the rise. Investors received a lineup of data that really gave some more proof of a cooling labor market, and that's increasing those bets for Fed rate cuts. Speaking of which, we had the Fed's John Williams say it'll become more appropriate to cut interest rates over time, and Beth Hammack repeating her views that she doesn't see the case for lowering interest rates this month. Now we head to the NASDAQ, up 0.6%. The Dow rising 0.6%. And the S&P 500 up about 0.5%. Over to the yield space, we have the 2-year, 3.59%. That's down 2 basis points. The yield on the 10-year, 4.18%, and that's down 3 basis points. Strong advances in Europe, where the stock 600 strengthened, up 0.6%. To commodities, a record-setting rally in gold. Well, it's starting to cool. We have COMEX gold down about 0.8%, $3,604 an ounce. And over to WTI crude at $63 a barrel, so extending the losses there. The Bloomberg Dollar Spot Index up about 0.1%. Tesla in the headlines on a few fronts. First, the company said it opened its robo-taxi app to the general public. And then second, the Trump administration taking steps to make it easier for automakers like Tesla to push out self-driving cars. What they're doing? Well, they're removing some requirements designed for human drivers, like windshield wipers. I like my windshield wipers. Tesla shares right now, they are up just a fraction, about 0.5%. And Reuters reporting BYD cut its annual sales target by 16% as it faces increasing competition in China. For on-demand news 24 hours a day, you can subscribe to Bloomberg News Now wherever you get your podcasts. I'm Lisa Mateo. That is the Bloomberg Business Flash.
Wait, does that mean that our Waymo doesn't need windshield wipers, Tim?
I don't know.
What does that mean? I love
You're not
my
going to see BYDs here anytime soon.
I don't know. Oh, okay, crazy.
I think Ed saw a lot of BYDs in London.
Oh, the BYD.
Yeah.
But I'm just thinking.
Yeah, Chinese EVs.
All right. We are ready. We want to talk a little bit about, as we mentioned, some more voices from the C-suite. So let's get to it. HealthEquity, shares of that company rallying for a second day as analysts raise price targets on the stock following earnings late Tuesday. The company administers health-saving accounts and flexible spending accounts, and it did boost its adjusted profit forecast for the full year. It also reported revenue and adjusted earnings per share for the fiscal second quarter that beat the average analyst estimate. So here to talk about the quarter, the outlook in the business is the company's president and CEO. He's Scott Cutler. And the company, if you're not familiar, $8.4 billion market cap. Scott joining us right here in studio. And full disclosure, we have HealthEquity cards, FSAs, here at Bloomberg. Full disclosure. I got to tell you, like, we all take these things for granted. We use them and so on and so forth. Lay out your business, though. How do you guys make money on all of this?
So we cover about a quarter of working Americans today would have an account with us. And I think the little known fact about health savings account is that they are the most tax advantaged savings vehicle that you could have.
Is that different from an FSA?
It is different than an FSA because an FSA is use it or lose it. An HSA is an asset that you should be saving in. You should be contributing at the max for a family is about $8,500 a year. And then you should be hoping that invest and grow over time because you can have it grow tax-free and then ultimately you can spend it tax-free as well for healthcare related expenditures. So it's a great account to have, but it's also great to be able to connect it to your healthcare, your wellness, and it's obviously a benefit that's provided by employers.
But it's not provided by every employer. I've been hearing about health savings account my entire career. I've never had one. I've never had the opportunity to have one. Is it because I've never had a high deductible health plan?
It's always associated with a plan, and I'll maybe talk a little bit about how it's expanding now under the new legislation. But it's first initially tied to a high deductible health plan, and the challenge is only about a third of people, when offered the choice, will select a high deductible health plan. The reality is a high deductible health plan, in terms of overall out-of-pocket costs, is typically no more expensive than a low deductible plan, particularly when you combine it with an HSA. And so you've got to select that plan
because
first.
Because of the tax benefits, you're saying? Or?
Yeah, that's how it was set up. And so you've got to select that plan, and then you can have an HSA that's associated with it. And so we look at adoption of high deductible health plans as one step, and then once you have one, you should be contributing and then using that.
Does it put the onus on the employee to make these financial decisions rather than the company? In that sense, like you have to actually go out. If you are offered a range of health plans where you work, which oftentimes people are doing, you don't necessarily have the information always to go and make that choice.
It's two things. One, as an employer, the challenge that you have is how do you manage your healthcare costs that are growing at 3 times that of wages?
Yeah.
And one of those things is plan construction. So plan construction around how many of your employees do you want and can you encourage to be in a high deductible health plan? Our best-in-class employers actually only offer a high deductible health plan. That's what we do as well. But we also match and we contribute and we tie that to great wellness behaviors. And so from an enterprise, this is a great way to control your healthcare costs. For an individual, this is to help you prepare for the healthcare costs that will come to you in retirement or in any health event. And you're preparing for that future. So it works both sides.
The Trump administration, first term as well as second term, has certainly expanded HSA eligibility for some plans and for telehealth services. Talked about those changes and what it's meant in terms of the activity you are seeing in the growth.
We have a whole new class of Americans now, following the passage of the bill, that now qualify to be able and are eligible for an HSA. So if you have and signed up part of a ACA marketplace plan, a bronze plan, you can now enroll in an HSA where before you were not eligible. And so that's true with the new legislation. So we're bringing in the largest expansion of the HSA eligibility in the last 20 years. So we think it's a big opportunity, but it's also an opportunity to educate individuals about why should I have an HSA and what can be used for.
You guys have a really interesting view of the economy because you see directly how many employees are being added to plans. We're getting some light data when it comes to employment in the U.S. We'll get a payrolls report tomorrow that might clear things up. ADP came in a little light today. What can you tell us about what you're seeing from customers right now in terms of labor?
So when you think about us, yes, we would see job churn, both hiring as well as people moving, as a tailwind for our business. Early in the year, we saw it. We said this market feels a little weaker. We were communicating that out to the street early in the year, and then obviously with the BLS revising down the labor statistics over the last couple of quarters, that's been very true. We still see that. And so it's a weaker job market overall, but also I think from employers, it's sort of this other thing, which is also healthcare costs overall are unaffordable for many people and even companies. And so how is it that you deal with both? And so we have visibility, I guess, into both of those trends.
Who's the typical person who opens up an HSA? I'm just curious, is there a specific demographic or no, all over the place?
No, it's as broad as the U.S. workforce would be.
Young, all over the place.
Old, yeah. And actually what excited me about joining HealthEquity was seeing my son who entered the workforce, his firm provided an HSA, how he was using it in a digital app, think of it as a stored value, using it in healthcare related expenditures, an integrated part of his health decisions, he and his wife. And I was like, this is a very cool company, great app, and was one of the reasons I joined.
You know, it's interesting. As Carol mentioned, we use, full disclosure, we use HealthEquity here. And also, it's not like we have a choice. I mean, this is what we are offered as employees. And I think that's the case for all employers who use services such as yours. They are given, this is the option when they sign up or when you start working somewhere. But I use it less for health stuff. I use it more for non-health stuff like transportation benefits, dependent care reimbursement, lifestyle stuff that we get reimbursement in that sense. Is that a tiny part of your business compared to the healthcare side?
So we have HSAs, and then we have other reimbursement accounts, as well as commuter and COBRA. So your commuter benefits would be through a different type of account. COBRA would be for unemployment, and then you have FSAs, lifestyle savings accounts. So all sorts of different accounts. Most of our business is in HSAs, but as we go to employers, Bloomberg being one, there's a host of products that employers like to offer as part of their benefit plan. And so we offer the host of those CDB products overall.
So, Scott, when you look at kind of the macro stuff that's going on and coming at us nonstop today, a lot of it coming out of D.C., I mean, what's top of mind? Is it just regulatory in terms of changes coming out of Washington that is most important for your world? Or is it also kind of where the economy is?
Well, in the healthcare space this year, we have a very active year on the legislative front, things changing. The one big beautiful bill was one of the fastest pieces of legislation that moved through both. And I think as you look at other things, expiring tax credits at the end of the year in healthcare are pretty significant. There's potentially big changes that could come if those tax credits do expire. And so, Washington, D.C., the regulatory front creates a lot of uncertainty around what's going to happen around legislative change. And then overall, some of the impact on policies, for a CEO makes you take a step back and say, hey, where do I want to take risk? Where do I see that risk? What can I control and manage? And, I think we see that. I see that as a leader as well.
What do you actively push for in Washington if you do have lobbyists? What do you want?
Yeah, I mean, we're actively lobbying in Washington. Our agenda has really been, how do you address the affordability crisis of healthcare? And how do you prepare more Americans for that healthcare expense? We do believe that access to an HSA is one way. We want to better connect people to saving and spending to their healthcare. We want employers to think about their role in that. And, I think if we're all involved in that aspect and we're connected to the healthcare decisions, we can drive costs overall of healthcare in the system down. And it's 20% of U.S. GDP. And those costs are rising faster. And so I think we all have an active role to play.
And not always with great outcomes, certainly here in the United States, despite all that spending. Scott, thank you so much. Really appreciate it. Come back soon. Scott Cutler, President and CEO of HealthEquity, joining us here on Bloomberg Businessweek Daily. We've got a rally underway, folks, and you are looking at most names in the S&P 500 higher right now. We're up on the S&P, a gain of about 0.6%, 6487. Dow Jones Industrial Average, a gain of about 0.7%, more than 300 points to the upside. NASDAQ 100, some outperformance there just by a hair, up about 0.7%. Tim, a gain of 164 points.
Yeah, the latest readings that we got on hiring and unemployment claims, talked about those a little bit with Scott, come on the eve of what economists expect to be the weakest stretch, Carol, of U.S. job growth since the pandemic. On the fixed income side, Treasury two-year yields dropping toward the lowest in almost a year. The S&P 500, though, seeing that back-to-back advance.
All right. So right now, just about 2 floors above us is a big event here at Bloomberg. It's called Power Players New York, and it's all about the sports world. And it comes on a day where we've got one really big story that caught our attention. The New York Giants agreeing to sell a minority stake in their storied franchise to Julia Koch and members of the billionaire Koch family. According to people with knowledge of the matter, it is one of the stories that's being talked about upstairs at Bloomberg Power Players New York. Let's get to it. With it is Bloomberg News U.S. Business and Sports reporter Randall Williams, who's been upstairs, I'm assuming,
Thanks
today.
for taking a break to hang out with us.
Of course. Anything for you all. Anything for you all.
Well, first of all, tell us about the New York Giants. I am a big Giant fan. Grew up, we had my dad, as we all got older and we didn't cost so much, he had season tickets and he would take one of our kids. I'm one of 7, so we'd all get a turn to go and my mom and dad would go. So I grew up loving the Giants.
And they had the same owner that they had now.
Forever.
Yes. Yeah.
I am shocked about this.
Look, the valuation is huge. We're talking about over $10 billion. They haven't put an official number on it just yet because it'll get approved in October. But $10 billion team now. And I mean, Julia Koch makes a lot of sense because she bought a piece of the net some time ago. It seems like she's going to buy anything in this market.
And the Koch family definitely has money to play around with.
Oh, absolutely. I think in some regards, if you were trying to buy this piece of the Giants that was up for sale, hearing that she was involved is like, oh, man. Like,
because close to $80 billion fortune.
Exactly.
Yeah.
Exactly.
Piece of cake.
Were you surprised to see a piece of the Giants sold off?
Absolutely. I mean, the Giants have been owned by the Maras and Tisch family. The Tisch families in 1991. The Maras go back 100 years. And the oldest, when you think about the oldest NFL families, they often don't sell stakes of the team. Now, I was not surprised that it was a limited partner and not private equity.
Which means what? That they don't get to make a lot of decisions?
Well, I think the nature of these minority investments is that both private equity firms and limited partners don't have a lot of say in the front office, in business decisions.
But it's an individual rather than a pooling of money.
Correct. And with
that's what surprised you.
Right.
Not surprised
No, it did not surprise me that it was a family or an individual, because the Maras, I mean, this is their billion-dollar business.
Yeah.
And bringing in Affirm when you have a stadium built, you have the #1 market in the U.S., it just doesn't make a lot of sense. So the Koch family is great.
The limited partnership, it's all about getting better seats. I know what it's about. Being in the cozy.
$80 billion,
That's what it's all about.
Whatever seat you want, whether you're on the team or not.
Great seats upstairs right now at
Absolutely.
Power Players New York. Tell us, it's been going on for a few hours now. What have you been hearing? Who you've been talking to?
We had just had Karl Anthony Towns that was in. He had a great panel with my colleague Ira Boudouet. I spoke to the WNBPA executive director alongside recent retiree Sylvia Fowles. We had Maria Sharapova. We'll have the commissioners of the MLS and NHL. There's a lot. It's been a lot of fun.
Are people upbeat? Like, we're always trying to figure out for the, different statistics in terms of what it says about the U.S. economy and the outlook. I mean, I don't know. When you see the valuations of these teams, you feel like everything's fine. Is there enthusiasm? Is there uncertainty? Is there any kind of cautiousness that you're hearing?
I think
upstairs?
there's a lot of enthusiasm, especially at Power Players. You feel it. Otherwise, the room wouldn't be full, quite frankly. I think if the business of sports was on a downturn, that these events, whether it would be Bloomberg or another rival of ours, CNBC, Front Office Sports Business Journal, Sportico, if the business wasn't booming, the people wouldn't be there.
Yeah.
And you wouldn't see a $10 billion deal the day before. So
how do people in an economy that might be losing a little bit of steam feel about discretionary spending on athletics?
I think it really depends on what you're trying to go to, because the reality is, yes, you might not be able to go to a New York Giants and New York Jets game, but the Liberty are over there and their tickets are a lot cheaper. Now, the Knicks aren't, and the Nets will be a little bit lower than that depending on who they're playing. But there are events you can go to. Now, look, sports are luxury experiences now. That's the bottom line. They're not what they used to be, where in specific markets you could walk in and pay for a ticket. It's not that way anymore. It's a booming business.
20 seconds. Is there a major theme? Sometimes it's been women's sports. Sometimes it's media rights. Is there a major theme? Or you could say no.
Let's go college sports. There's a lot going on in college sports, and Janet Lauren has been incredible. So tune into her.
We're going to be talking about college sports over the next 2 hours.
Yeah, she's going to be joining us along with the athletic director over at Dartmouth, Mike Harity, joining us.
Great. All right. Great stuff. You teed us up so well. Randall Williams, thank you so much. U.S. sports business reporter at Bloomberg News, joining us in studio.
I'm Tim Stenovec along with Carol Massar. Let's take a look at some stocks on the move. Today, joining us now is Bloomberg News cross-asset reporter Emily Graffeo. She joins us here in the studio. Emily, company's still reporting earnings, and that's causing stocks to make some pretty big moves.
Yeah, that's usually what tends to happen.
But I said still because it's like really the tail end of earnings season.
Captain Obvious.
Wow. So surrounded by people who are so kind. I love it.
Yeah, it's been a pretty good earnings season
like
for most of the S&P 500 companies, companies beating on EPS. But Salesforce is a stock that's not doing too well. The ticker is CRM. It's down about 5%. Biggest drop since April, and it was down as much as about 8.5%. They projected lackluster quarterly sales growth. They see revenue $10.2 billion to about $10.29 billion, which was the estimate. So they didn't miss that much, but the talk on Wall Street now is that this is kind of sparking a little bit of an AI anxiety. They're an incumbent software provider. And so there's this fear that maybe newer up-and-coming AI companies are going to be able to kind of beat out these incumbent SaaS
like
providers.
maybe we won't need all their services, right?
Yeah.
AI will be doing it, which is kind of wild. You have good genes. Tim has good genes. I have good genes.
You gotta. God.
This is the talk.
Carol.
It's just an ad.
Yeah.
It's never just an ad in
I
2025.
think what we're learning,
Carol.
what the market is telling us, is that it is just an ad, and perhaps this is a lesson in, all publicity is good publicity at the end of the day.
Exactly.
Of course, we're talking about American Eagle, a record jump in the stock, ticker AEO. It's up 35%. It's actually the highest level since 2024 because the stock had been going down. It had been a rough ride for this retailer that's kind of known for like middle school clothes. At least that's how I think of it. But yeah, they came out. They said that they reported better than expected second quarter revenue, and they did attribute it to some success following the Sydney Sweeney ad campaign. Everyone was talking about it.
And Travis Kelce ad campaign.
Yes, and Travis Kelce.
Even the president was
well.
talking about it.
Yeah.
Yeah, well, the president was talking about Cracker Barrel too, and that wasn't a good thing for the company.
You just have all these people and how much social media momentum over this. Like, thank you. It's incredible advertising.
Yeah, it feels a little bit like meme stocky. It definitely has some hallmarks of that when you see a jump of this magnitude. But yeah, a record high in American Eagle right now.
All right. I love that you're going to go to this next one because it's among the most read story on the Bloomberg terminal. T. Rowe Price, just got about 30 seconds.
Yeah, T. Rowe Price, ticker TROW. It's up about 6% right now. It was up over 12% on a partnership with Goldman Sachs. Goldman is going to be investing as much as $1 billion in T. Rowe, and they're basically partnering up to sell private market products to retail investors. This is the theme of 2025. Everyone on Wall Street trying to package up private markets and sell it to anyone who's willing to buy. So even if that means teaming up with kind of someone who's a competitor, it's a move that Wall Street.
How's it going to end, Carol?
Strange bedfellow. I know, John Tucker this morning. What could go wrong? What could go wrong? Just, a perspective. Emily Graffeo, thank you so much. Check out our Stock Movers podcast, 5-minute episodes, biggest winners, losers. Find it on Apple, Spotify, or anywhere you get your podcasts. The close coming your way on TV, but we, over the next 2 hours, mega highlights from the Power Players Summit. Who do we have, Tim?
Derek Sprague, CEO of PGA Americas, and also A-Rod joining us on the show. That's next on Bloomberg Businessweek Daily.